Hey everyone, it's Doug the Retirement Guy, and we have some interesting and new stuff for you today. The new highest income ETF that's 10 years old. Doesn't make sense, does it? Income, and then we fixed the growth. Fixing the growth and the income of a new fund. We're going to cover it all today, and before we do, we got to do a big shout out to all of our Patreon supporters and all of our YouTube subscribers. Thank you so much for being part of this channel and helping us continue on this adventure of helping people get ready for retirement. Let's get into today's video. Well, the income dilemma that we face is so many people are looking for high income that they're giving up on growth. So that old teeter-totter scenario really fits well. When the yields are artificially high and the capital appreciation is often the cost of the funds, you see this tipping both ways. The in-reverse relationship, there's an inherent trade-off between income and growth. You typically don't maximize one without pulling from the other. And what we find a lot of people doing is those yield traps. Chasing those big double-digit yields often means sacrificing capital appreciation, so shrinking your portfolio value over time, especially in today's markets. The true goal is find an instrument that offers consistency, reliable income without destroying your principal capital. I believe that's what everyone's really looking for. Now let's do a comparison in the spectrum. Understanding the structural trade-offs between traditional dividend growth strategies and modern high-income derivative strategies makes for some big differences here. So a passive dividend growth, the examples that we use is the Charles Schwab and the Vanguard series, the VYM and the VIGs. And we're going to put those up against the high-income covered call funds like the JPI, JPQ, and QYLD. Now, this is where we're going to see some trade-offs back and forth, and you'll end up seeing where the teeter-totter kind of fits into it, and where a lot of retirees start struggling with this side of things and saying, which do I want and how do I need it? We'll start with the yield. Now, the market yield is driven by the underlying company payouts. So when we get into the passive dividend sides of it, you're looking at 2 to 3% is what they're getting from companies because they're focused on that growth side of the business. We go over to the high income side. This is enhanced yield generated by selling option premiums. We can see income numbers between 7 to 12%. So you can see where it starts teetering back and forth. Do you want growth? Do you want income? Now the growth side, now it's very high on the dividend growth side because it's uncapped potential. Full participation in bull markets and stock appreciation, while your high incomes cap that upside because of those covered calls. The gains are sacrificed above the strike price because of generating income. Now what does that do? Well, the volatility, the next big piece. It's a higher volatility on the passive dividend growth side because it moves in lock and step with the broader market. So full exposure to the drawdowns, the ups, the downs, everything. While you have lower beta with that monthly cash distribution buffers the price swings to reduce the volatility. So you can see that whole teeter-totter thing I just talked about where you got the ups, the downs, every which way. It's going back and forth, boom, 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 boom. And you have this problem. Now, a lot of retirees struggle with this. And this is why we did a video about a retirement strategy and a retirement portfolio. And I'll post that at the end of the video that we use both of these into a building block and building package to where you have some growth funds that are helping grow the funds to cover for inflation and other needs, but you also have high income that helps to create that income that you need to live off of. Then, of course, you always have your foundation funds. So these work together, but this next fund that I found that we, like I said, it's brand new, but it's also 10 years old. And we're going to share with you right now what that fund is. So now the sweet spot, the solution that we're talking about and that fund is DIVO, D-I-V-O. It's the Amplified CWP Enhanced Dividend Income ETF. Now, DIVO is an active managed ETF designed to provide income and capital appreciation. You heard me right. It's income and a capital appreciation. While many funds will focus on income and secondary of a capital appreciation, or they'll say we're a capital appreciation and or with a look at income. These guys are dialed into both of them, and they built their strategy around this. DIVO selects the high quality large cap stocks with a history of earnings growth enhanced by a technical covered call strategy. You're right, a covered call strategy, and you're talking about a capital appreciation. Well, their strategy has changed, and this is why they're the new kid in town. They change what's going on, as companies will do. They're changing their strategies to try to achieve what is needed in marketplace. Now, DIVO came out December of 2016, so we're almost 10 years old on this fund. $6 billion is assets under management, and it's a monthly payout. So when we take a look at the program right now, before the strategy shift, they were averaging about 4.5% yield. Their new target's going to be between 6.5% to 7%. Okay, for that yield, that's your income side of it. And then you have capital appreciation coming next. So when we take a look at the performance and strategy, now they're outperforming the benchmark through a technical active management. So when we take a look back on this fund, in the blue line you see is DIVO. In the gray dotted line, that's the S&P 500. And then the other benchmark is going to be JPEI. Okay, you can see, yes, it's had an ups and down road. Just very similar to what the S&P 500 is kind of doing. But it's outperforming JPI. Now, beating the benchmark over the past year, DIVO has not only provided superior income, but it has historically outperformed the S&P 500 by capturing the upside, limiting the downside. So what is the strategy they're using? Well, they're using a 20% technical covered call. That means they write calls on individual stocks, not the index, on about 20% of the portfolio to generate income, while the rest of the fund, 80% of it, is uncapped for growth. So the majority of the portfolio remains unhedged, allowing the fund to capture full market upsides during the rallies. So it's an 80-20, 80% for growth, 20% for income. Versus a lot of the funds out there are either A, reversed, or dialing more into doing covered calls on 100% of their portfolios and not capturing any upside. Now, we always have to look at the beta advantage. Now, the beta, what this is positioning for optimal balance of volatility and capture. As we see on the scale, we've always said low volatility, high income. This is where JEPI comes into play. The low beta, 0.7%, is a defensive high yield capped upside. The balance beta of 0.85 from DIVO compared to SCHD at that 0.95. So you can see the volatility is a little higher in the SCHD because they're looking for growth all the way through. JEPI is lower because they're looking on the income. They're controlling what they're doing. And DIVO plays right in that middle slot. So in a bear market test, okay, when we do the testing, you can see DIVO is really only down 1%, while Charles Schwab would have been down 4%, and the S&P 500 down about 18%. So you can see it really is balancing in that sweet spot. So you're not losing as much, but you're not putting all your monies in this big egg that's going to give you huge payouts in the income, but you're getting both growth and income. Now we take a look at tax efficiency structure of this one. Another unique way. 2 to 3% of their distributions are qualified. And then they use 3 to 4% again into the return of capital. So when you're getting about 7% total targeted yield, you're covering that between these two categories to give you a lowest possible tax rate out of an ETF. So when we say 2 to 3%, that's 2 to 3% of your yield is coming to you as qualified dividends, while 3 to 4% is done off of return of capital. So why does quality matter? Earnings and growth. The direct link between corporate earnings and long-term price appreciation. The earnings growth, consistent revenue, and profit expansion drives the price appreciation, which in return creates that total return gain that we're looking for. Charles Schwab focuses on a passive index strategy. Now, they've been a very, very good fund. I am not bad-mouthing them in any way. I'm actually saying the Charles Schwab methodology is screened specifically for stocks with high yields that are sustainable. While DIVO is using select stocks based on earnings growth first, regardless of yield. Kind of almost want to put it to you as, is Charles Schwab chasing yield, dividend yield, and DIVO is really chasing total return. Kind of an interesting twist when I started really doing my analysis between those two. Because the limitations are often missing high growth compounders in the tech leaders because their yields are so low, despite the massive earning growth that could be, while DIVO can hold lower yield, higher growth giants like Microsoft or Visa and manufacturer yield through synthetic via covered calls. So it's like DIVO's working better and I'll call it superior than what Charles Schwab has done, and they are the benchmark across the board in a lot of those type of funds. So really, DIVO, the balanced choice, it's a unique instrument to bridge the gaps between passive growth and high yield income strategies. I really take this as a long-term core holding. This is something that's in my portfolio. I will say that to you up front, and it just came into it after doing my research. I said, yes, I'm adding this to my portfolio. So this was not done for a video to promote that. I did it long beforehand. But I also suggest you do your own research. Don't just take my advice for anything. Here's what I looked at. You have attractive yields target at 6.5 to 7% annual yield. You're getting monthly distributions. You're getting capital appreciation because that 80% of the portfolio is uncapped, which I loved. And the high conviction strategy that they're holding in their portfolio, top 10 holdings, represent 60% of their portfolio. So they're really banking hard on the top 10 pieces. Now, we say downside protection, and it's proven resilience through bear markets. But, granted, I can say that there is no real built-in true downside, but they do build accordingly because they are buying higher level funds. So overall, that's what we found for you today. And I'll tell you what, if you like what you're seeing, hit that like button. It helps the channel the most. Leave any comments down below. Maybe you own DIVO. Tell me your experiences. Maybe you're thinking about it, or there's no reason why you're not. I love to hear your opinion across the board. What do you think of DIVO as with their new changes in their strategy? Now, here's another question that come out too is where do you keep your emergency fund or idle cash? Now, this is not a sponsorship for the channel. I'm just helping people out because I get this question also. What do you do with your earnings and so on? And I found this place called Bankrite. Now, Bankrite is a great company that will search and find the best rate savings accounts. Okay, I'll put the link down below. You can scan the QR code here, but I'll just show you what I did for myself. When I needed a bank account, I was switching out of Bank of America. I went and found this, thought it was very interesting. I found VO Bank I never heard of before. It's FDIC member paying over 4%. A 4% in a bank account. It blew my mind. So this is just something to help people out. This is why I did the channel, to help people out. Scan the link, scan the QR code. If you're looking for a checking account, if you're looking for somewhere to put your money at, look on that, click on those blue buttons on the side. It'll give you all the detailed information going on. Just a helpful hint going forward. This is not advertisement. It's just helping you out across the board.
Thank you for watching. Press the